And we also see more recently the phenomenon of this AI revolution and what that means for data center energy consumption, and the fact that people are realizing, especially technology companies, that natural gas is part of that equation in terms of a cleaner, reliable, on-demand source of energy.
Well, welcome everyone. We're happy to have Dennis da Silva, our senior portfolio manager on our commodity funds and our flow-through funds at Middlefield, and special guest, Marty Staples, CEO and president of Topaz Energy. We'll have a quick chat today on energy, oil and gas, and infrastructure here in Canada, and why at Middlefield our equity income focused funds loves names like Topaz that provides us exactly what our investors want, which is dependable streams of income. So thanks guys for joining me. I'll ask this question and I want each of you to kind of give me your views on it. And each of you wake up each morning, Dennis running the portfolios, Marty running the company. And really, you're waking up needing to provide growth and income for your investors. Do your stakeholders prefer high levels of income? Do they want you to invest back into the business? And Dennis, your mutual fund and ETF holders, do they prefer high levels of income or do they prefer buybacks? So maybe Marty, I'll start with you there.
Yeah, and great question. We really have a mixed bag of investors where some people want to see us never increase the dividend again and just use all that excess free cash flow for future M&A. We set up this business to always pay a dividend and hopefully never take it down. Since IPO in October of 2020, we've done 8 dividend increases, so 65% increase to the dividend. Alongside that, the business has grown almost 4 times. So when we IPO'd the company in October of 2020, we're $89 million of EBITDA. We now sit around $350 million. But alongside that growth, we always felt it was important to increase the dividend and output of the business. And we've done that. I think every time you've seen us grow at the 4 to 7%, we think we grow organically every year. You can expect a dividend increase alongside that. In addition to that, when we do M&A, strategic M&A, we look to grow the dividend as well. So 65% increase to the dividend. We've paid out almost $700 million in dividends since IPO. I think that's a remarkable number. And continue, we think next year will be around $1 billion of dividend return to investors. We're at a 65% payout ratio right now. When we started the company, it was about 90%. So we really had to work hard to find that excess free cash flow inside the system. After we pay out that $190 million of dividend, we have about $100 to $150 million of excess free cash flow. We either replenish the balance sheet or look to do new M&A. And we've continued to do that.
Well, we like the monthly checks, but we also like the growth that you're providing in our funds. And Dennis, why are we so focused on equity income at Middlefield? And
yeah, I take Marty's comments to heart, in that investors in our energy infrastructure mandates really are looking for those predictable, stable income streams. It's a core part of their total return expectations. And when I think of energy infrastructure, things like pipelines and midstream plants, these are typically mature assets that have a very predictable cash flow stream and can also deliver, low single-digit rates of growth. And typically, when you look at those assets, probably the total return, more than half of it comes from dividend income. So I think as a space, it's uniquely situated to provide those steady income streams. Because at the end of the day, when you look at energy infrastructure assets like the pipelines and midstream plants, they are typically generating the revenue from take-or-pay contracts with inflation escalators. And this is a nice way to ensure the predictability as well as the increasing sources of cash flow and thereby the increases in the dividends that we're looking for over time. I think when you look at our basket of favorite infrastructure names, including Topaz, over the last 3 years, the CAGR has been about 5.5% growth in dividend income. And I think of Enbridge, another one of our favorite names. they always remind us, look, over the last 20 years, they've outperformed the S&P 500 by 150 basis points on an annual basis, and they've increased their dividend 29 consecutive years. So I think it's a testament to the underlying strength of this business model.
Well, there's lots of Canadian retirees thanking both of you for those growing streams of dividends, especially in this inflationary time. Marty, let's just kind of talk about how Topaz was formed. It was spun out of Tourmaline, which is Canada's leading natural gas producer. What's your current relationship with Tourmaline? How does that benefit Topaz?
Yeah, September of 2019, we were in Toronto, and I remember Mike Rose, the CEO and president of Tourmaline, said, hey, there is a generational opportunity coming to purchase oil and gas assets we've never had access before. And we just got to find a way to do it. He didn't want to go out and raise equity because a lot of capital was retreating from oil and gas, not just because of ESG movements, but what came right after that was COVID. Debt was a four-letter word at the time. We felt like interest rates were going to go up, and he definitely had a crystal ball on that because interest rates spiked by almost four to five-fold. And so we had to invent something that would allow us to access capital, and that's how Topaz was born. It was September of 2019 at the Peters & Co. conference that he came up with the idea. October, we announced it. In November, it was a done deal. Tourmaline spun out Topaz. They owned 74% at the time. It was about an $800 million transaction. We assisted Tourmaline in their growth needs to become the largest gas producer in Canada. They doubled the size of their company. Topaz quadrupled the size of their company, though, because when companies saw what we were doing with Tourmaline, they kind of phoned and said, hey, what they're doing to access capital, can we do that too? We added Advantage. It was our first company that we did a gas plant deal with. Tamarack Valley right after that, Headwater, Whitecap, New Vista, Strathcona. And so I've added really high quality names to our portfolio, 7 public companies that people would know very well. And in turn, we were able to grow our business alongside that. So Tourmaline now owns 31% of the entity. They do kind of envision of being at least 20% inside the ownership. But where we've been useful is we've been able to help them achieve their acquisition goals and needs. And I think that partnership is going to go forward, and I hope it goes forward. When you think about what you want from a royalty infrastructure standpoint, largest Canadian gas producer, 5th largest in North America, investment grade entity, cost of capital continue to facilitate their growth needs through capital needs. So we're pretty pleased with the Tourmaline relationship and hope it continues to go forward.
Well, it's a great partnership, and you're having high quality partners is a testament to your success so far. On the topic of natural gas, Dennis, your infrastructure strategies and energy mandates have healthy weightings of natural gas, infrastructure holdings and producers currently. Tell us why this commodity is core to your current energy exposure.
Yeah, look, natural gas, the way we envision it is it's kind of one of those necessary solutions to what we call the energy trilemma, which is how do we find secure, affordable, clean energy sources? And we see a number of drivers that kind of illustrate that. We've seen already the coal to natural gas switching and transition. We see the expansion of LNG capacity in North America. Thankfully, LNG Canada is flaring, as you said, currently, and first expectations of shipments in the first half of 2025 and further expansions in the US. So that's going to be a major draw for natural gas. I think you use 10% of Canadian natural gas will go into LNG directly through Canada or into the US. And we also see more recently the phenomenon of this AI revolution and what that means for data center energy consumption, and the fact that people are realizing, especially technology companies, that natural gas is part of that equation in terms of a cleaner, reliable, on-demand source of energy. So I think those are very important characteristics for the demand draw. And then I look at energy infrastructure names as uniquely positioned to expand their pipes, their plants, in order to move natural gas, not only within the North American basin, but globally through LNG. And what that means for us is those expansions mean nice single low-digit growth, dividend increases to our unit holders and the energy infrastructure mandates.
Well, it's an exciting time for natural gas. And Marty, your history of working through many of these cycles in the patch, what excites you about the future of our business, the energy business in the country, and why could it be different this time for Canada?
Yeah, and like first of all, I mean, I think the royalty business is the place you want to be for these cycles, and the royalty infrastructure hybrid model we have is the perfect spot to be. We kind of see opportunity when commodity cycles go lower. From an M&A standpoint, we make more money when commodity cycles are higher, and kind of shore up the balance sheet and get ready for the next counter-cyclical event. So we kind of aren't as concerned as we used to be at an E&P space, where you would take your capital and have to drive it back into the ground. We take our capital, keep our dividend policy consistent, and that is a very appealing thing, I think, for investors. What's changed in the landscape right now, you've got TMX in full service right now. The 890,000 barrel a day pipeline is currently around 700 to 750,000 barrels of production. So you're accessing more of a global market from your oil. And does that compress the price? I think it does. Mm-hmm. And overall, we've seen that happen already. Right now, we're sitting at a $13 to $14 differential. So that's improved, and I think it'll continue to improve. LNG Canada, I talked about that before. You've got 2 BCF going off the West Coast. LNG Canada becomes live in Western Canada, and we hope that we're going to be able to capture more of a global gas price. We've been restricted from where we can transport natural gas. We use a lot of it interprovincially. Our only access to export natural gas was to the US. Now you're accessing an entire global market. So that's exciting, I think, for the Canadian space. That's exciting for Canadians because you're going to see more revenue into the system from a tax perspective even.
Right. Yeah, it's something that we need, help build more infrastructure, roads, bridges, schools. So, well, that's great, guys. That was a great chat about energy and what we're doing. And maybe next year we'll reconvene and see what's happened over the next 12 months. But thanks, everyone.
Yeah, thanks very much. Appreciate it.
Thanks, Brian.